In this video, I will show you why you will never reach 7 or 8 figures in crypto without fixing these 3 habits. Most traders think they lose money because they picked the wrong coin or missed the right entry. That is not true. You lose money because of these 3 habits I am about to show you. Invisible patterns that quietly destroy your execution while you still believe you are being strategic. You can read charts, track macro, and know exactly what Bitcoin is doing. But if you have one of these 3 habits, you will always give it back. That is why most portfolios never reach 7 or 8 figures, let alone 9 figures. Not because they cannot, but because the person managing them keeps repeating one of these 3 habits. Today, I'll show you what those 3 habits are and how smart money avoids them entirely and how you can just copy them. Let's jump right into the first habit, which is chasing price. One of the biggest mistakes that traders make is chasing price. This habit stems from the illusion that hitting a specific higher number will magically save or grow their portfolio, with leading you to ignore real market signals. It is not simply a lack of analysis, but rather a fundamental misunderstanding of how markets operate, which can trap even experienced individuals in cycles of disappointment and underperformance. So what is it that you do? You set fixed price targets and lock your mind onto that number as the ultimate goal. You wait, you hope, and you overlook everything in between, treating the market like it owes you that exact outcome. This approach creates a rigid mindset where flexibility is sacrificed and opportunities for adjustment are missed entirely. Smart money, on the other hand, operates by using a clear system with well-established sell zones, while retail traders chase the visible price action without understanding what's going on in the midst of euphoria. So let me make an example. Think about how everyone throws around Bitcoin targets, like 180,000, 250,000, or even 500,000. But on what basis? Was it using some sort of technical analysis, some strategy, or because the Federal Reserve will print this much money? And within what time frame? Is it in 2 years, in 5 years, in 10 years? Or is it going to happen during this cycle? Many traders say, oh, if Bitcoin hits 150,000, my portfolio will be worth $1 million. That is when I will sell everything. They fixate on this fantasy, missing clear top signals that appear far below it. For instance, during a bull run, sentiment might shift due to external factors like geopolitical news or macroeconomic changes, causing a peak much earlier than anticipated. Yet the trader holds on blindly. A real-world parallel is the 2021 Bitcoin cycle, where smart money sold at resistances around 60,000, or retail chased 100,000 projections, only to face a 70% correction that wiped out gains for those without a system. So what is the lesson in all of this? The market does not care about your targets. It moves in cycles, liquidity zones, and psychology, not wishful thinking. If you're stuck on arbitrary numbers driven by emotions, you will miss corrections along the way and set yourself up for failure. Who guarantees that level will even be reached? This approach keeps you reactive instead of proactive, often leading to holding through deep drawdowns. Furthermore, it prevents you from capitalizing local tops and bottoms, resulting in suboptimal returns and increased risk exposure over time. From a smart money perspective, this is exactly how institutions exploit retail. By creating euphoria around round numbers like 100,000, 150,000, 200,000, or all-time highs, inducing FOMO, fear of missing out, that leads to liquidity grabs where your stops get hunted and you end up selling low after buying high. So what is it that you do instead? So very simple. Build your own exit strategy around timing, not fixed prices. Use resistance zones, funding rates, open interest, sentiment like fear and greed index, and USDT dominance to spot when the market is overheated, when we're at clear resistance, where a local top could form. Sell during local tops and re-enter at local bottoms to move with the market. That is how professionals operate. They execute with precision and not with the so-called perfection. Remember, you must be like water. Resistance zones on the higher time frames will remain, but new ones will always form, and top signals will appear at different times. The market is fluid, so you've got to adapt and flow with it. You've got to go with the market. By adopting this method, you align your actions with actual market dynamics, allowing for more consistent growth and better risk management. Monitor sentiment, macro, and apply technical analysis as shown in my timing masterclass. My timing masterclass is completely free. It's my first ever video. You can find it. It's about 1 hour, a bit more, and it explains everything. It's mostly meant for investors with 6, 7, 8, 9 figures, and also for higher time frame traders. So if you open maybe a trade a week, or every week or so you open a trade or two, it's also meant for you. This structure replaces emotional chasing with clarity and control, creating the consistency needed for long-term compounding. Before we get into the second habit, if you are serious about growing your portfolio and finally getting to your dream numbers, feel free to schedule a one-on-one diagnosis call with me. It's the first link below in the description. I will analyze there your current portfolio, your situation, your system if you have one, and point out your weaknesses that could cost your portfolio and show how you can improve it. So no pressure at all, first link below. Let's get back into it. Habit number 2, entering a trade without an exit plan first. Most traders jump into buys without thinking about sells, planning entries carefully, but handling exits based on pure emotion, which is a recipe for losses. This oversight is common because the excitement of entering a position often overshadows the discipline required for exiting, leading to impulsive decisions that erode potential profits. In smart money trading, this is equivalent to entering without understanding the market structural intent, where institutions plan the entire campaigns from accumulation to markup to distribution well in advance, leaving retail traders exposed to manipulation without a predefined escape route. Well, you focus all your energy on spotting the perfect entry, but when it is time to exit, you act without a clear plan, letting greed or fear dictate the move. This lack of preparation means that your trades are not fully thought through from start to finish, creating vulnerabilities in your overall strategy. You can avoid this by using a combination of top signals and resistance zones, similar to the first habit. So let me make an example here. Imagine buying into a promising altcoin after detailed chart analysis, but without predefined sell zones or sell signals. When the price pumps, FOMO kicks in, and you hold too long only to watch it crash. Or worse, you panic sell during a dip, missing the rebound. Consider a real-world scenario where a trader enters a position in Ethereum during a bull cycle, expecting endless upside, but without an exit framework, they end up selling at a loss when volatility strikes unexpectedly. This mirrors events like the 2022 Luna collapse, where smart money exited early via structured plans, while emotional retail holders rode the wave down, turning potential gains into catastrophic losses due to the absence of clear sell signals and scaling strategies. So without a plan, you're gambling, not trading. That's the truth. Timing the absolute top is unrealistic. And emotional exits mean you miss capturing most of the move while failing to protect your capital. This leads to inconsistent results and eroded confidence over time. Additionally, it fosters a pattern of regret and second guessing, which can deter you from making future trades with the necessary conviction. Smart money thrives by exploiting this retail weakness. They create temptation zones to trap emotional exits, sweep liquidity from panic sellers before reversing, which underscores why a lack of structure keeps you in the cycle of frustration and away from the precision you seek. So what is it that you do instead? Before clicking buy, define your exit plan. Set sell zones across indexes. Use trusted top signals and structure for scaling out in parts. Let data, sentiment, and market structure guide you. Sell with discipline. Move profits to your dry powder bucket and stay ready for the next opportunity. Accept that perfection is not needed and not possible. A solid system gets you close enough to win. Implementing this ensures that every trade is approached with balance, enhancing your ability to compound gains systematically. You look for top signals, for example. Open interest is at an all-time high. Funding rates are overheating. The volatility of the volatility index against others indicator is in the decrease exposure zone, meaning you should sell. USDT dominance is overbought on the 3-day RSI with a bullish divergence, meaning USDT is going up, meaning more cash. People are moving into cash. Bitcoin just formed a 3-day bearish divergence, meaning Bitcoin is likely to go down. All of that would be a clear sell signal where you would start to get out of the market in trenches. This framework builds emotional control through rules-based execution, turning your analytical strength into consistent, predictable results that compound your portfolio towards 7 and 8 figures. That keeps you in control while others spiral. Let's get into the last habit, the third habit. And this mindset does wreck most traders, and more than poor analysis ever could. And it is you believing that a smaller portfolio means different rules apply. So you treat it like a lottery ticket instead of serious capital. It is a deceptive belief that smaller stakes allow for looser strategies. But in truth, it amplifies vulnerabilities and hinders long-term scaling. Smart money rejects this entirely, viewing all capital, regardless of size, as a tool for systematic allocation, where every dollar is deployed with great discipline to avoid the traps that catch retail gamblers. You chase quick wins with high-risk bets, hoping to rocket from 6 to 7 or even 8 figures overnight, staying fully deployed without any structure or preservation strategy. This all or nothing mentality keeps your capital constantly at risk, preventing the accumulation of steady progress. In contrast, smart money rotates through phases of accumulation, markup and markdown, using dry powder cash to capitalize on liquidity wicks created by over-leveraged retail positions like we just had on Friday, one of the biggest liquidity week ever, the biggest liquidation, ever recorded in crypto history. There, some coins plummeted 70, 80, even 90%. You could have bought coins with limit orders in a matter of minutes, made 5x some coins. But if you don't have cash on side, you can't do that. With a 500,000 portfolio, you dump 50,000, so 10% of your total, into a low cap meme coin, betting on a 20x return, for example. If it moons, you gain $1 million. If it flops, you're down 10% in one shot on your whole portfolio. Compare that to a $5 million portfolio where 50,000 is just 1%. So failure barely hurts, but success still adds big, a whole million. To illustrate further, picture a trader with a 100,000 account going all in on on a speculative token during a market frenzy, only to see it evaporate in the liquidity crash like we just have seen last week, resetting their progress entirely. Here's the lesson. Traders with less capital have a smaller margin for error, yet they are more likely to go all in and lose it all. Thinking like a gambler keeps you stuck in six figures because you're always exposed with no rotation of dried powder, cash, like I teach in the 3-bucket system video. It is not about luck, it is about failing to compound sustainably. This perspective also ignores the power of compounding through disciplined incremental gains, which is how true wealth is built in volatile markets. Smart money leverages this by creating the very environments that exploit gamblers' mindsets through engineered volatility that punishes overexposure, ensuring that without a structured approach, you remain frustrated by inconsistent results and unable to break free from retail noise. So what is it that you do instead? Well, you simply treat your money like professionals do, with a system and not emotions. They don't have some secret. They're just like you. And those systems are very simple. One of the systems I have shared in my 1-hour masterclass, it is very good. It works very well. And I have timed literally, I think, every local top and bottom this cycle with this strategy. So, and I'm not some super genius. So think in percentages, not amounts. Rotate positions, take profits regularly, keep cash ready, and never go all in. Use buckets for allocation, focus on capital preservation, and operate like an allocator, not just a trader. Master execution and structure to multiply wealth steadily. By shifting to this professional framework, you create a resilient portfolio that can weather downturns and capitalize on upswings effectively. To operate like smart money, adopt the 3-bucket system. Your core bucket, the majority of your portfolio, holds conviction assets, so blue chips like Bitcoin and Ethereum, to keep you exposed throughout the entire cycle. Then your harvest, that captures volatility from altcoins, usually 20% of your portfolio, and it locks in profits before the crowd. Then you have your dry powder, which will grow during the cycle. So by the end of the cycle, most of your money will probably in the dry powder, meaning cash. This one waits patiently for crashes and local bottoms, ready to reload when others panic. So this is your secret weapon. Use tools like Relative Strength Index, also called the RSI, and Bitcoin dominance to time rotations, ensuring emotional control through predefined rules. For example, if Bitcoin dominance, meaning Bitcoin will outperform most altcoins, is showing clear upside signals, so Bitcoin will outperform most altcoins, you want to rotate out of altcoins. This not only provides the predictability you need, but also builds a compounding machine that grows your six-figure portfolio into a 7-8 figures without relying on gambles. So let me summarize the 3 habits again and how you can fix them. The first one, chasing price targets. So what was the issue? You lock onto random highs like Bitcoin at 150,000, ignoring real market moves, cycles and tricks from big players like fake breakouts in 2021, which leads to missing tops and big losses. The fix to this is focus on timing with indicators like resistance zones, funding rates, open interest, sentiment shifts, divergences, relative strength index, or USDT dominance to spot overheating. And sell zones. Sell at local highs and re-enter at dips like pros who focus on precise execution over perfection. Then we have the second habit. No exit plan upfront. The issue here is you nail entries but let emotions handle sales, losing out on gains. Like in the 2022 Luna crash where smart money planned ahead and cashed out while others panicked. The fix to this is very simple. Plan exits before buying. Set sell zones across indexes. Use trusted top signals and structure for scaling out in trenches. The third habit, treating your portfolio like a lottery ticket. The issue here is you go all in on risky bets with no safety net, which wipes out smaller stacks fast. Like in the latest crash where we had almost 20 billion wiped out of the market in a matter of minutes. So what is the fix? Think in percentages. Rotate holdings using Bitcoin dominance, altcoin pairs like Ethereum against Bitcoin, split into buckets, core blue chips, harvest mid-risk plays, dry powder cash. Preserve your capital to compound without the drama around it. So you will most likely not reach 7 or 8 figures through luck or hope. Those times are over. This is not 2016-17. This is 2025. You will get there by mastering execution, building exit plans, and treating your portfolio like a business. Every dollar has a job in your portfolio. Every professional trader operates with structure and discipline. That is what allows them to multiply wealth when everyone else loses it. Fix these habits and you will be on your way to 7 and 8 figures. Have patience. So that is it for this video. If you need help with your portfolio, your system, make sure to apply for a one-on-one diagnosis call with me, where I will analyze your current situation, your portfolio and system, and point out your weaknesses and show you exactly how you can better your situation and what you can improve. So first link below. May God bless you.